All right, let's dive right in. If you're one of the millions of people who have been watching the housing market, just holding your breath and waiting for some kind of sign, then this is for you. We are tackling the one question on everyone's mind. Is it finally a good time to buy a home? Now, the answer isn't a simple yes or no, but by the end of this, you'll know exactly what to look for. Let's get into it. For years, it's felt like that dream has been drifting further and further away, right? But what if the tide is finally turning? Could the path to owning your own place actually get a little bit easier as we head towards 2026? We're going to break down some pretty crucial data that suggests a change might just be in the air.
So, let's start with the good news because honestly, there's a genuine glimmer of hope out there for buyers. And it all comes down to that one number that can make or break your entire monthly budget: the mortgage rate.
And here it is. This is the number you really need to know right now. Freddie Mac's latest report has the average 30-year fixed-rate mortgage dipping down to 6.23%. Now, on its own, it might just look like a number on a screen. But trust me, this single figure is the engine that's driving a whole new wave of optimism in the market. But, context is everything. That 6.23% looks even better when you see where we were just a year ago, sitting at 6.81%. Now, I know that 0.5% difference might not sound like a ton, but on a 30-year loan, that translates into real money, actual cash, back in your pocket every single month. And to really put this into perspective, some data from Mortgage News Daily is suggesting that rates are now hovering near a 3-year low. So this isn't just a minor blip on the radar, folks. This is a significant downward shift that's been a long time coming.
And these lower rates? They're having a real-world effect. We're already seeing more people jumping back into the market. Mortgage applications are up 8% in just a week. And what's even more telling, applications for those government-backed loans, the ones often used by first-time buyers, they're up 9%. That's their strongest week since 2023. People are starting to make their move.
Okay, so financing is getting a little cheaper. That's a huge piece of the puzzle for sure. But what about the other monster in the room? The actual sticker price on the house itself. Are homes actually getting more affordable? Mike Simonson from Compass just hits the nail on the head when he calls home prices the story of the moment. It's that classic supply and demand scenario from Econ 101, right? There are more homes on the market, and there's been less demand for a while. Put those two things together, and you finally start to see that downward pressure on prices we've all been waiting for. Okay, now this is a really crucial distinction, so let's break it down. Over on the left, you see that overall home prices are technically still creeping up, but at a much slower pace. The real story for buyers, the thing that actually matters to your wallet, is on the right. The price per square foot, what you're actually paying for the physical space, is actively going down. And how much is it falling? By 1.5% compared to just 1 year ago. So what does that actually mean? It means that even if the final price tag hasn't totally crashed, you are getting more house for your money than you were last year. That's a tangible win. But it's not all straightforward good news. To get the full picture, we have to do a little reality check and look at some of the mixed signals and conflicting data points that are keeping this market on its toes. The first piece of this puzzle is something called pending home sales. And it's pretty simple, really. This just tracks the number of contracts that have been signed but haven't officially closed yet. It's a great way to get a sneak peek of where the market is headed in the very near future. And here's the twist. Remember all those new loan applications we were just talking about? Well, despite all that fresh interest, the number of people actually signing contracts just took a pretty significant hit. In fact, it's the biggest year-over-year drop we've seen in 8 months. So what gives? And this is where the market starts to feel, a little confused. On one hand, you have formal indicators like demand indexes and those signed contracts trending down. But on the other hand, Google searches for homes for sale are at their highest level in months. It kind of paints this picture of buyers who are window shopping with intense interest, but they're still hesitant to actually walk in the store and buy. So with all this conflicting information, what on earth does it all mean for the future? Let's zoom out for a second and look at the big picture for 2026 and the key factors you really need to be watching. Looking ahead, it really all boils down to 3 major economic dominoes. First, inflation. If it continues to cool down, mortgage rates could fall even further. Second, the job market. A strong one gives people the confidence they need to make a big purchase. And third, the big one, what is the Fed going to do next with interest rates? As Jake Krimmel from Realtor.com says here, if these 3 things line up in just the right way, cooling inflation, a strong job market, and a Fed rate cut, the housing market could charge into 2026 with some serious momentum. It's a conditional if, for sure, but man, it is a powerful one. Which brings us right back to our final question. We've got falling rates, we're getting more house for our money, and there's a whole lot of pent-up interest just waiting on the sidelines. So those big economic dominoes fall the right way. Could 2026 really finally be the year the market tips back in favor of the home buyer? The signs are there. But for now, we watch and wait.